Yeah, recording is started.
Perfect. So, hi everyone. Thanks for joining us on a Saturday evening, and I welcome Rohit and Kedar from RC Capital Management. Those who have joined, the majority of us already know about the work of Rohit. He has brought value investing through his blogs to Indian investors almost 15 years since he started his blog, valueinvestor.com. And overall, he started his investing in mid 90s, almost 2+ decades of rich experience. And since he is an avid reader, his focus has always been reading diverse books, and his value investing is more or less initially influenced by the legendary investors Benjamin Graham and Phil Fisher. He has been sharing his work through blogs and also through various sessions like the one we have today. And the session for today is process beats ideas. So this is going to be one of a session, and I think all of us who have joined here are going to benefit big time. As a standard disclaimer, this session is purely educational, and we appreciate if you take the learnings from the session as a starting point. And by no means we want to influence anybody's buy sell recommendation, to say the least. But yes, you can surely take that as a starting point. Idea is to evolve as an investor who is more into do it yourself, and the touch points or the learnings over more than a decade will be shared with you during the course of the session. And certainly you can have relevant questions at the end of the session, or maybe even midway you can write those questions in the comments. So Rohit, welcome once again, and I appreciate if you tell something more about RC Capital Management, and then we start with the session.
Thanks, Prince. We've had sessions, with you in the past also. So I have me and my partner Kedar, who is also on the call. We have been running this advisory RC Capital Management for 14 years now. But again, that's only from an advisory standpoint. We'll not get into that discussion. It's a long-term oriented, value-based kind of advisory. So anyway, that's about us. A lot of you may be aware of, us through, the blog and through our Twitter account. So appreciate all of you joining today on a Saturday evening. We just went through the standard disclaimers. I think needless to say, we are going to discuss individual stocks, but they are not ideas, right? They are not recommendations to buy or sell. There's no specific view currently on these positions. We may or may not have a position in any of these stocks, right? So again, standard disclaimer. Both Kedar and Prince will help in terms of moderating the session. Please go ahead, and I cannot see the chat window as I present. So please go ahead and put your questions in that. Prince and Kedar, if you guys can please moderate that, and we can have questions. We can do this as an interactive session. I don't want for me to just keep speaking for 1 hour continuously. Let's try to make this an interactive session, because that's the entire purpose, right? We want to make this as a teaching session. We have kept it at an hour. If there is interest, it's a Saturday evening, right? And it's going to be 10 by the time we complete. We can continue a little bit further also. So we'll decide on that. So just let me know. We've had a little bit of technical difficulties in starting. Just let me know if my screen is again. I cannot see the chat
It's
window.
perfectly yeah, perfectly fine. The chat window I'll see in the meanwhile, so we can start with that,
Okay,
Rohit, and certainly
sure.
the audience can raise their hands and we can address their questions from there.
Sounds great. Thank you, Prince. So let's standard disclaimers. We'll just move forward with that. We just spoke about it. This is, the standard disclaimer from an advisory standpoint. So let's uh, let's come to the point of what is it that we are trying to present, or what is it that we are trying to say? What is it that I'm trying to, message I'm trying to put across? Uh, the hypothesis or the claim I'm trying to make in this call is that the key to investment success is to have a structured, and each of these words have been chosen carefully, is to have a structured and evolving process which is driven by curiosity and learning. So let's break this down a little bit. What do you mean by investment success? It does not mean you are successful in a specific year. It does not mean you are able to find one multi-bagger here and then you can obviously tom-tom about it. Investment success means being able to do well, and if you are an active investor, that would mean that you are doing better than the benchmarks, and you do that for a very long period of time. The time is the crucial element. Uh, in investing being a probabilistic exercise, someone will do well, at some point of time. You can always luck plays a very big role in doing well from year to year, but the key is that a process is what drives success for a very long period of time. So that's the claim I'm trying to put across. And the second
Hey
part
Rohit,
of this claim, yeah.
are you still on slide one? Because what we are seeing is slide one.
Oh, you're still seeing slide one. I'm on slide five.
Yeah.
So
Now it has
Okay, we
changed. Yeah,
saw it
now it has changed.
now. Okay.
Yeah,
okay, so I think my
now it's okay.
presentation mode. You know what? I will stop the presentation mode because I am seeing the presentation mode. It is not helping. So let me just keep this mode itself. It'll make the whole this easier, right? So I'll just uh, make it this way, right? This is much better, right? It's visible
Yes.
easily also,
Yeah,
right? Okay, so
yeah.
let's do that. So this is apologies. This is the slide I was talking about. The process is the key, right? The claim which I am making in this session is that investment success, which means doing well than the indices over the long run, if you're an active investor, involves having a structured and an evolving process. And the second claim I'm trying to make, which I will try to obviously convince all of you by the end of this session, is that ideas are dime a dozen, and they are not the key driver of investment success. So I know that's a big claim to make, because at all times we see a lot of noise on social media, right? People are talking about this multi-bagger idea and this great idea and that great idea, all kinds of noise online, and it's only increasing now. But I'm trying to make the claim that it's only a small part of doing well over the long run. And anyway, ideas are commoditized. You can, to build a portfolio of 20 stocks, the challenge is not finding the stocks. The challenge is finding which 20 stocks you should put, or 25 stocks you have to put in the portfolio, right? So these are the uh, two claims I'm trying to make at the beginning of this session. And so let's go about, go about breaking it down further, right? And this is what I've said, right? Um, why am I saying that ideas are plenty, right? Because I can tell you that I have missed several multi-baggers even after knowing about them. So for example, I would know about a company, I've studied it, it is staring me in the face, like the world is talking about it, and we'll come to those examples. But I still was not able to recognize it and did not invest in it. And I'm sure if you have invested actively, a lot of you would have faced that. You would have either convinced yourself otherwise, or you would not be able to see what others are able to see. That's the key point, which is bullet number 2. Being able to see what others are able to see, or being able to really connect the dots, right? So news, technicals, financials, these are all individual data points. They don't form the full picture unless you have a process or some sort of a fancy word for that is a mental model. And let me give you a few examples of how this happened, right? So I don't know how much this is visible, but this is the chart of Balaji Amines, right? Again, disclaimer, right? We don't hold it as of now, but I have called this chart out from 2012 to, some recent this thing, maybe 23 or 24, whatever it is, right? And I don't know if this is, let me go into the pointer mode. Okay, here you can't see the pointer mode. Okay, is my arrow visible, Prince and Kedar? Like when I'm moving my cursor
Yes.
Yeah,
and
it's visible, and the participants can always zoom out so that they can see it.
right. So you will see, and the reason why I said, is it visible? Because if you see on the left-hand corner, there's a small red box on the left-hand side, which I've called out. So that's the time, and maybe some of, the our clients also will remember if they have been, if one of the old timers have joined, we had Balaji Amines in our portfolio. And I'm, very specifically saying we had, again, not a recommendation or anything. We had Balaji Amines in 2012 and 13. Again, it had a chemical business. It also had a hotel business, which was a little bit of a pain because it appeared like misallocation of capital. But we sold out, right? And nothing was happening. So needless to say, we understood the business. It's not like, we did not know about the business. And you can see a long period of not much was happening. There was a little bit of a bump over here where the earnings started. And then starting 2020, and obviously most of you are would be aware of it. 2020, after COVID, the whole chemical theme came up, right? Like, chemical companies are the next, next great thing. And we always see that from time to time, right? It would be chemical, and then it was PSUs in the past few years, and then defense, and then CDMOs, right? The story keeps changing. But and I knew about this company, but I just kept watching it, right? Why? Because again, when I look back at my notes, I had 10 pros and 10 cons, right? But the point was the single most important element was the concept of industry themes. Like when there is a story, oftentimes, the stocks will run up. So again, I come back to the same point, right? Like the original point which I made. You can know about the company, you can know about the data, but if that mental mindset or that mental model is not there, you will not buy it. Obviously, you can be in the other extreme where anytime somebody recommends something, you jump and buy that, right? But that's a sure path to disaster. I mean, you have to have your own, independent thinking, and independent thinking only happens when you have set certain, mental models in place. So anyway, this was the reason. Let me go to the next one. Next example, Avanti Feeds. Now this was a position which we held, and we've long since exited. But this circle which you can see, we were holding the stock at that point of time. Both me and Kedar used to talk about it, right? There was obviously a negative um, perception about the industry at that time. This is in the early 2000s. The feeds industry and the shrimp industry had this whole negative kind of a perception because of the tough times the industry had gone through. And then obviously as it came to 16 and 17, the industry structure changed. And then all of a sudden, and this is a very old example but very pertinent, somewhere around the mid of 2017, the demand kept growing and there was a sudden drop in the input prices. If I remember correctly, it is mostly fish meal and corn and so sorry, soya inputs which go into the feed production, and those prices dropped. And this exact point, it's not visible, but there was an earnings announcement, and the earnings suddenly grew by like 200% or something, like a huge surprise happened in that particular quarter. And we were holding the stock, and we did well. But the point being, I did not understand the concept of an earning surprise. It's now called PED. It's now called, uh, you know, um, uh, episodic pivot, all kinds of different names, but the concept is the same. When suddenly there is an earning surprise or there is a catalyst, the stock goes into a different trajectory. And you can obviously, and we'll come to that. You can play with that. You can invest based on that. But we did not have that concept, so we benefited. But maybe we could have increased our allocation and benefited more. So same thing, right? Holding a stock, looking at it, having all the data, but not being able to connect because that mental model was missing. And then the next one I will come is from an error, right? We used to hold this stock since then we have exited. This is the period when, the company was going up. And then around this period, which is 2018, July and September, the ILFS crisis happened. And, the cycle for the financial industry turned. And then obviously all the stocks started going down. And, we did not appreciate the concept of cyclicality or the concept of stage analysis. Now, those of you who follow stage analysis or technicals would know this whole concept of stage one, where the stock is just um, basing, it's not moving around all the moving averages. This is the 200-day moving average. This is the actually, I think I have taken a daily view in this one. But anyway, right? So the 200-day moving average would be flat. The 50-day moving average would be flat. That's stage one. This is usually the rising stage. Usually people call that as stage two. This is when, the stock is flatlining, stage three, and this is where the breakdown is happening. So you don't have to get very fancy. If you understand that once a stock starts dropping through all the key moving averages, it is entering into stage four. And roughly around in this zone, it makes sense to, to start exiting or to start reducing, proactively. But again, we did not understand that concept. And, we obviously paid a price for it. So what am I trying to drive in all these slides? What I'm trying to explain is that, we can be given an idea, we can be given we can even be holding an idea or a stock idea. But if you do not have the process and you have not you don't understand those various conceptual bits, or if you, let's say, if you're a particular type of investor and there is an opportunity from a different viewpoint, you will not see it. The seeing part is the most crucial part, and which is why, even if you have ideas recommended to you, even if you're holding it, you will not get the full benefit unless you have a process and you understand the various elements of how you can take benefit of that opportunity. So let me pause here, Prince. Any questions or anything from the audience? I know we went through one section. Just take a pause here.
I think, Rohit, we are good, but just one question that is more
Right.
around the process. So basically, whenever, I mean, majority of the participants do remain fully invested, right? After that, any
Mhm.
particular idea comes to them. So how they
Mhm.
can, I mean, evolve their process in the sense that because selling one idea and getting into another takes something which normally we do not do, right? So
Right.
how to condition our behavior in that aspect, I would request you to tell.
So I think, and this is where we will circle back to it as we talk about the different um, ways of investing, if you may, right? And it's a very good question which you have asked. I will very briefly touch upon it, and then we'll dive deeper as we talk through the various, various approaches to investing. And let's take two opposite spectrums of of this particular question. Um, so let's say, right, you are a swing trader. Your window is 3 to 6 months at best, maybe 3 months, versus you're a buy and hold. Two opposite extremes, right? The buy and hold person will hold the stock for 5, 10 years, maybe never want to sell. The swing trader is working on a 3-month time frame. So the first question we have to ask ourselves is, which type of investor are we? If you are and I'm terming all of everyone as an investor being someone who knows what he or she is doing, right? I think that's the only definition I would want to put around it. Not say, someone who's investing for 5 years is an investor. Somebody who is doing it for 6 months is not an investor. Yeah, maybe you can call them a trader, but that doesn't matter. So if you're a 3 to 6 months kind of a window, there the better idea concept has a much bigger role, right? you are constantly churning your ideas, and it's part of your existing process itself. So it is almost as if your entire process is built around churning your ideas. And we will come to this point of time horizon. Your time horizon is 3 to 6 months. So you're constantly churning through it. You're like a DMart who will turn their inventory very quickly. Correct. So there is no concept of will I buy and I will hold it. On the other hand, a long-term buy and hold person is looking at a lot of qualitative factors. They want to hold it for 3 years, 5 years, longer the better. And over there, the whole process of looking for a new idea has to cross a much higher threshold. And the threshold, at least as I have spent more time on investing, I realized the threshold should not just be a quantitative one. It should not be that this company may be giving me a possibly has a slightly higher upside, and hence I should rotate out. Oftentimes it will depend on subjective factors, how much confidence you have on the management, that they will be a good caretaker of your and they are right. They you can partner with them for much longer in spite of this short term hiccup. What are the prospects of the industry? Is it an industry with a 5 to 10 year runway, or is this like a slightly a cyclical play where you would want to hold it 3 years? So those are the questions I think we have to ask ourselves. And I think as we go through these different stages or approaches to investing, hopefully it answers that question even more.
All right. Shanti Prakash or maybe Bhushan, right? He has his hand raised, so perhaps he can unmute and ask his question.
Yeah.
Mr. Shanti Bhushan, you there? Anyways, Rohit, we can continue. He can
Okay,
maybe
let's do
ask
that.
later.
Yeah, sure. So let's come to the point of having experienced these issues. um, how did I go about the next stage, right? So one of the things which I would, and I put a post on this just very recently on the blog. The link is provided, the link is over here. It's how to become an investor, right? Designing your learning process. So one of the things you have to do, no matter what your stage is, that you have to keep notes of what you're doing, and you have to again look back at your own success and failure. And based on how you think about your stocks, or how you what work you have done, you should be able to explain what happened. I am not saying predict, but you should be able to explain, which is different, right? A particular stock went down, right? Or a company um, did not do as well as you expected. You should be able to understand why that happened, right? For example, you have bought in a steel cycle, in a steel company. It's a upfront that it's a cyclical play, uh, and after you buy, all of a sudden China announces some major subsidies and steel prices crash. So you could not have predicted that the steel prices will crash, but as you had analyzed, that this was a risk which you obviously cannot forecast, but you could explain that the prices crashed because this is one of the risk elements which materialized, and that caused the price to go down. But for example, if something happens which you're not able to understand, right, you're not able to explain why that happened, like you do all your analysis and you still are not able to explain why this is happening, uh, then you have to look as to what is missing in your process. Like why are you not able to understand why did the stock, like for example, right, a stock which you expected to do 20-30%, maybe 100%, suddenly spikes and goes up 5x, and you are looking at that stock and saying, why is the market going crazy? I think the fair valuation of a PSU is just 2 times book value, but the market is being crazy and they are valuing it at 5 times book value. It doesn't make sense. The moment you say it doesn't make sense, you have to start thinking deeper. And that is what I did, and that took me through learning concepts of technical analysis, learning charts, momentum, other factors of investing. And there are multiple. We will not dive deeper because That's a topic of its own. Quality, growth, understanding the markets, and different styles of investing. So, for example, if in the past I would look at a company and say the market is being irrational, and they're just bidding the stock up 3x, 4x, way above the valuation. Now it may, or you may still call it irrational, but I can at least explain why it is happening. And the reason is couple of things. One, it's about momentum, right? Once a stock starts rising, it has a certain price momentum behind it, and then valuations don't matter at that point. So earlier I would always think it is getting overvalued, and anytime it can correct, and that is true. In a long enough period, uh, uh, valuations do act as gravity, but during shorter time periods, from and there is enough research around it, 9 to 12 months, momentum is the key factor. So if the market is in the momentum, the sector is in the momentum, the stock can keep going up for a very long time before suddenly you can have a crash. So that is the explanation. You should not be looking at valuation and saying why is the stock doing so well. And you can see that that messaging on social media a lot, right? People will be calling, oh, this stock is so overvalued, it is stupid. No, it is not stupid. It depends on your point of view. If you are a value person who holds this for 3 to 5 years or 10 years, yes, it doesn't make sense for you. If you are a swing trader, it doesn't matter for you. You're not looking at valuation. So as I went through this exercise and I looked at all of these, what it allowed me to do was to look at what is happening in individual stocks in the market and put it in the right bucket and say, you know what, after a result has been declared, the stock has suddenly dropped and the numbers were not too bad, but the stock dropped by, let's say, 10%. And maybe it is because swing traders have made around 20 to 30% of what they were expecting, or 20% profit, and they're just exiting out. The story is still intact. And if my viewpoint is that I want to hold this for a longer period of time, that 10% really does not matter. So so those are the things which you should, which I went through in terms of understanding different elements, how other investors work and behave, to form a better picture of what is happening in the market. So I'll just stop here, Prince. Any questions from anyone?
There are a couple of them actually.
Yeah.
One is from Senthil Kumar. What is the duration in factor in investing?
What is sorry,
Sorry,
can you repeat?
what is the
See,
duration factor in investing? I think
In
he meant
investing,
that.
right? So the duration factor is, in fixed income, for example, the duration is so let's say, for example, you buy a fixed deposit versus you buy a bond, right? The concept is that duration is the period of holding for that, right? A fixed deposit may be 1 year duration, a bond may be 10 year. So oftentimes, there are fixed income investors. It does not matter for equity investors, but for fixed income investors, the amount of risk premium they want to get depends on the duration. And equity investors have the highest duration, right? It is as a whole, even if your duration is short, as a whole, if you are going to, equity investors will hold forever, so they want the highest equity risk premium. Same thing, like if you're a swing trader, your duration may be 3 to 6 months and you're ready with a certain risk reward. But if you're a long term buy and hold, you know that you have a higher risk and maybe you would want to be compensated accordingly. So duration is basically the time period of holding, or the time period for that investment.
Hi, Rohit. Am I
Yeah,
audible?
yeah, go ahead.
Hi, Rohit. Thanks for this. Just a quick question, right? So you have focused on relearning, but can you just elaborate a bit on what is your basic process of arriving at businesses? Like, what factors do you look at
Hmm.
when you arrive at certain businesses or sectors? Do you go top down, like go from sector level to the stock, or
Right,
you go bottom up? Depending on the macros or whatever macroeconomic, like China plus one during COVID, right? Balaji Amol.
right. So
Thanks.
actually, in the subsequent slides, as we talk through the different sub processes, I think this question will get answered, and it's a little more nuanced. It depends on which hat I'm putting on, and we'll talk through the multiple hats of the process. And that, it's a very good question, but it's more nuanced. It depends on what is it that you're trying to do. Are we trying to be a position trader? Are we trying to be a growth at reasonable price? Are we trying to do deep value or buy and hold? And it ties directly into the process, and that's exactly the slides which we are going to follow with, right? It
Sure,
depends
sure.
on the
Thanks.
style
Yeah.
of investing, and that's precisely the point. Actually, you've just hit upon that. That your process depends on your style. What you will do as a swing trader, it will be a complete, will make absolutely no sense for a buy and hold, and vice versa. And actually, that is why you see all this, back and forth in social media where people are not sure as to what the other guy is doing, right? One person is thinking like a value investor, the other person is talking of swing trading, and they argue about valuations, right? It is two people playing one person playing football, other person playing cricket, and discussing about the ball, right?
Absolutely, I think, and
Two
the
totally
other
different
challenge is
things.
like we keep jumping around like as a layman, right? If I
Correct.
look at multiple, I follow multiple people. It's difficult to focus on one style, and
Correct.
you keep on jumping around. Thanks.
Correct.
Please carry on.
Yeah, we'll get on that.
Just one
Any other
point,
questions,
just one
Prince
question.
or
Rohit, hi, this is Samir Huli. You
yeah?
referred to mental model as well. Maybe because of the mental model, you said like, this doesn't fit into my criteria or my bucket. So how do you improvise
Right.
on your mental model? I mean, definitely a lot of learning required here and adaptation.
Right.
But that doesn't relate to the style of investing, I presume, right? I mean, if you can throw a little bit on that.
All of these things are interconnected. So the way you develop your mental model is a fancy way of saying, patterns are being able to recognize certain patterns, right? So that's a fancy word which has developed of saying, I have a mental model. And how do you develop additional patterns in your head? By being curious, by having that deep interest in the markets, not limited to I will make so much and so much money. Obviously, that is the end goal, that is the scorecard, but by being curious. And that is what this slide is about. When I could not figure and we could not figure, or connect the dots, the idea was why. And then, you start exploring, have an open mind, right? We see that oftentimes, right? People will just, somebody will talk about, technical analysis is dumb. Somebody will say fundamental analysis is stupid, right? Somebody will say swing traders are not really investors. The first step, I think, in doing what you were asking is, let go of all of those blocks in your mind, right? Keep an open mind, start reading wide, right? And I think, as you again, I started as a novice in technical analysis 5 years back when I started looking at this. The first time when I picked up charts, I could not make head and tail out of it. It was almost, being a beginner at that time. But after you get through that phase, it takes at least it took me a couple of years to develop as a value investor, and then it has taken me a couple of years to understand technical analysis. Difference between you know understand and proficient is big. I'm not proficient by any means, but at least I understand technical analysis, uh, near about understanding about momentum. So I think, to your point, right, the way you develop is there is no standard formula, right? You have to have curiosity, and you have to learn at least the basics of each of these areas, and then start connecting with what you are doing. And we'll go through that, right? As we go through some of the subsequent slides, we'll talk through it. We'll be able to connect these questions which you guys are asking. Any other questions before we move on, or we can take it while we are?
Hi,
I think
am
Shanti
I
Bhushan
audible
had.
now?
Yeah, go ahead, Santosh.
Yeah, thanks for taking my question, and apologies for the previous mishap. My question is related to in the previous slide you talked about the blog post that you wrote about how to become an
Right.
investor, part 1 and part 2. My question is specific to one element which you may choose to answer right now or maybe later. The
Right.
question is twofold. The first question is related to in one of the posts you talked about AI tools. It is able to help you support the research process. So
Right.
maybe if you can elaborate on that. And second, and how it is helping you and what process you take with these AI tools. And second question is related to the earlier monologue when you talked about even if you have a good stock, unless you have the process, you may not be able to get the full benefit if you're
Right.
not seeing how to position that stock in your portfolio.
Right.
So my question is related to whether, based on your experiment with the AI tools so far,
Mhm.
whether you are able to integrate some of these new tools that can
Mhm.
help you in better seeing those opportunities and
Right.
have a better decision-making process using those tools.
Okay.
Thank you so much.
No worries. I will not spend too much time because the on the AI tools, because that's a session and a topic of its own. Uh, I will just put it as a single line comment. Think of these tools as a very smart, fresh graduate or an intern coming out of college. They can do what you ask them to do very fast. So let's think of them as a research analyst who is working with us 24 by 7, can do my work in 5% of the time, but it cannot think on my behalf. That has been my experience till now. Now, will it start thinking on my behalf? If it happens, then we'll see, right? So, which comes to the second part of your question. No, it cannot. It cannot make the if you have to take one takeaway for these tools is that you are the person who has to ask the right questions. These tools give you the best. You cannot find anybody who can give you a better answer in a lot of areas, but the questions have to come from you, and the questions come from our own learning. Should I look at the stock from a viewpoint A, B, and C? You have to ask that question. The tool cannot tell you that. The tool will just regurgitate whatever it'll give you a very fuzzy answer. So if you are going to look, let's say, for earnings surprise stocks, you have to say, I am looking for an earnings surprise stock, and this is my criteria. That work you have to do. And the tool will help you speed it up, automate it, you name it. But all the points, it will not tell me that I should be thinking of cyclicality and I should not be holding a steel stock when the steel cycle is coming, is going down. Okay. But in terms of how I use the tool, I will park it on the side, because that is almost another a full-fledged session, and maybe if there is interest, will plan something around that too. Yeah, let's
Thank you.
move forward, right? We'll again I think maybe we will end up covering some of these questions which are coming up. So um, I think we are roughly halfway through now. Let's come to the original point which we made, right? I said, right, ideas are not the key drivers. Hopefully, I've been able to convince all of you that you can have an idea staring in your face, but if you don't have the mental model or the process, you will not recognize it. Right? That's the simple way of putting it. Now, the next point which comes up is everybody talks about the process, but what are the elements of a process? You will not, in books, uh, when people talk on social media and post, you will rarely see somebody really elaborating a process out, right? It is mostly experiences around, somebody did this and they did that, but not too much gets spoken about process definition. So let me go ahead and start. You know, let me give you some ideas around how you can define a process. Again, keep in mind, a process is, there are certain outlines of how you can build a process, but in the end it is a very individual exercise. It depends on your own temperament and what is it that you are wanting to achieve, right? So the foundational elements of a process, you can say, is, for the first thing you have to start and you have to answer for yourself is, what is your time horizon? There is nothing fashionable. It is fashionable to say I'm a long term investor, uh, and this is somebody who has tried to follow that for a very long time, and that's why I think I can at least criticize my own tribe for sure, right? It is fashionable to say that, but there is nothing special about it. There are enough successful investors who have 3-month horizons, 18-month horizons, a couple of years horizon and a long term. So you have to just define, at least take a stab and say, I am this kind of an investor. Maybe you can then tweak with it as you go along, but you cannot, the temperament for a swing trader or a 3 to 6 months trader is very different from somebody who's going to hold it for 5 to 10 years. So you will know that answer anyway, right? You have to start thinking of what kind of what kind of investment factors you are going to look at. At a very simple level, right? You could either be a value type of an investor, or you are a momentum type, and we'll get into that, or you gravitate more towards quality. And then there are certain market tendencies which you should learn, which tie with these investment factors. So, for example, reversion to mean is basically the concept that prices, returns, industries tend to revert to a certain mean. If they swing in a certain direction, if they go too high in terms of valuation, they will come back to their median. If they go too low, they will go back. So that is where the whole value type of investing plays. And then in those interim periods, value again occurs. The value plays out over a 2 to 3 year period. So if that is your horizon, then don't go into momentum investing, because momentum investing usually is a 9 to a 14, 18 months kind of a window at best. So if you say I want to do momentum investing, but I will hold it for 5 years, then you're asking for trouble. Catalyst, again, catalyst, we spoke about earnings being a catalyst. And then volatility contraction and some of the other, trading aspects come if you have a very short term horizon. So point being, these are not formulas, but you have to understand these concepts as you're building your own process. So use all these different foundational elements, and I may not be able to do enough justice in this meeting, because this can almost be like a 1 day session for us to go through each aspect and talk about in detail. So
Rohit, I had
yeah.
one question. So let's say different ideas, right? Could be like you could be generally, let's say you could be having a value base and probably have a longer time horizon, or you could be doing a catalyst based investing per particular idea, right? Like something you think, okay, it's more likely to go through, and if it doesn't go through, what the chances of loss I possibly gonna get? Obviously, may or may not be right. Right? Let's say you put some idea, right? You put some time frame behind it. Obviously you might be having in the head, and there's one point whether you wanna writing it down, whether it's piece of paper or in a document, basically concretize is better. And second thing is, sometimes the things may or may not go exactly in those timelines.
Right.
So how much of flexibility do you so sometimes like everybody would have seen if they do it right. So if you have an idea, you may be sold too soon, or maybe bought too soon. So, and basically you got up the idea much earlier because this did not happen during that time frame, or
Right.
maybe I could have waited, say, a few months more, right? So how flexible, like say I put, let's say, 2 years, right, or 3 years. So is it like a hard, or you can put exactly a hard date? Well, that's what
No, it
sometimes
doesn't work.
you feel more confidence. You let it run a little longer. I don't know. So what's your thought about that actually?
So couple of quick bullets in that. One is majority of the investors, people who have done this for a long time, if they get a 60 to 70% success rate in being able to have stocks in their portfolio where they make money, forget about timing and getting it perfect, where they are able to make money, they do exceedingly well, like 60 to 70% of the time, right? It's closer to 60% than 70%. So one thing, if you are a new investor or you have spent a little time, is to drill a simple point in your head that you will make a lot of mistakes a lot of times. Like, make peace with that. It has taken a long time for me to make peace with that point. This is not a college exam where you will score 98%, and I'm maybe from a previous generation which used to score lesser, but the younger kids make 95%. You will not make 95%. You will not score 99%. Okay. If you're going to do 60 to 70%, you'll be successful. So that's point number one. You will get it wrong all the time. And what you do after every time you get it wrong is you understand, explain, and you improve and iterate your process. Second, when I spoke about these horizons, these are not hard and fast. But when I say 2 to 3 years, does not mean you cannot, you would not want to hold more than that, or you will not exit earlier than that. It can happen. This is before you are getting into an idea, not after. If you are a position trader and your view is 6 months, and the stock at a certain point of time has met all the conditions for exit, don't don't let your emotions run wild and say, now what, I will let it run for 3 years and then I will let it run for 5 years. Right? Don't do that. Right? Versus if you already if you are an investor who says I have a horizon for 3 to 5 years, and then after 3 years you realize that the story has changed such that I can hold for another 3 years, you're kind of underwriting the position one more time. Right? So there is no hard and fast rule around this, right? But it should be an exception. If after every stock idea you start as a position trader and you say I will hold this for 9 months, and then it turns out to be a 3-year idea, and either you will be successful at it, which means then move into that time horizon. If you are unsuccessful, then fix your rules. But again, these are guidelines, right? I mean, it's not like a formula which says you should hold for 2.2 years or anything like that. Right? These are different buckets in terms of how, where you can place yourself.
I'll give you actually, maybe I was not clear. So I'll give you an example. I bought something is like about so okay, and maybe I bought too soon. And fundamentally, let's say it's 2 3 years, roughly 2.5 years. And the actually, it's not that the idea is wrong. Company is actually doing pretty okay. Its earnings are increasing. It's just that the return profile is not, because I probably bought too soon, and so returns are still okay. So basically now, obviously, I have not got the return, but considering the price has not done, because price was already high enough. It went down and it's sort of catching up now, but the earnings are increasing. So obviously, my when I say 2 3 years, it's from the price point of view, or it's from the, like, let's say if it's a fundamental idea, right? Or from the earnings point of view, earnings are improving. So obviously in that case, obviously, okay, I'll not gonna stick to it. Obviously I did not make the return that I was looking for, maybe because I made a mistake earlier, right? But fundamentally it has not destroyed the story, because company is still doing okay, right? It's just that it's not going as fast. Maybe like when obviously, let's say COVID time, something was going that fast, right? So obviously it corrected, it didn't go that fast, but it's still going decently fast. So that was my idea, because in that case, what I did, okay, maybe it's not fitting me. I thought probably going to be better return, but it might still turn out to return in longer
So
time.
that's a more complicated question for me to answer. I think we may not be able to take in this call. Let's do one thing. Let's park this question. I will maybe I will try to address it through a post, right? Because it has a lot of nuance in it. And unfortunately, right, if I continue on that, we may not be able to continue with the presentation. So let's do that, right? Maybe if you can please type that question out. Sorry, I didn't catch your name, but definitely I will I will try to address any of such questions which come up. If we can't address in this call, I'll try to put a post on it.
Yeah,
Okay.
sure, I'll do that. Yeah.
Okay, so let's move forward on this, right? We spoke about what are the elements of the process, right? And we said, right, you would want to have a search criteria. You want to look at the next step is to generate a watch and a focus list, right? So you would have these various criteria to search for an idea, and that's where keep in mind the elements which I spoke about, right? You would use that criteria to search for ideas. You would want to filter that into a watch list and a focus list. That then you start analyzing, and again I put multiple things, does not mean you will do all the things, right? And we will take three different very key, we'll take three different ways of investing to look at what you will do in each type of investing. And then you need to have an entry criteria, like what will be my position size, what will be my risk reward analysis. Once you have made an entry, you need to have a position management approach, like how much should I buy, what price point should I buy, what should be my valuation, if that is important, and you should have an exit criteria. So the point is that your process should have these headers, if you may, or these sections. How you define this section is up to you. What you can do is you can use these elements to define this, and we'll talk through three different approaches in that. Doesn't matter, what you're doing, whether you're a whether you're a long-term buy and hold or you're a swing trader, it should have all these 6 or 7, whatever, steps which are involved. So let's go through, 3 examples, right, as to, how you would build your process with these different elements. And I'll start the first one with one which, we have done this for a very long time and we're most comfortable, right? And again, this is not all comprehensive. Each of these one can be, a session of its own. So we'll just quickly, touch upon, as a, um to give you a flavor of, how you can build your process. So let's say, you're a growth at a reasonable price or a buy and hold type of an investor. Your search criteria, and this can be screeners, or this can be, you can go into screener.in or anywhere, and you can set these filters up. You are looking for companies which are showing you a growth of 15% and ROC or greater than 15. And again, there are different variations of how much period and how much, all of that is there, that nuance is there. But for time being, we're just keeping it simple. We're saying growth greater than 15%, maybe 3 years, ROC greater than 15%. You're trying to look at you're trying to evaluate the management quality. Again, topic of its own. Unfortunately, it takes, but let's say, you're looking for a good quality management because you're going to buy and hold the stock. The management quality does become critical. And then, is there does the company have a competitive advantage? And why are we talking of those two bullets? Because there is no time horizon, right? In the long run, which is more than 3 years or 5 years, these become extremely crucial. Management quality and competitive advantage plays a very big role in the success or failure of your idea. As you are doing your technical and fundamental analysis to narrow down your focus list and arrive at that those couple of positions, more or less, as this type of an investor, you're going to ignore charts. What you are going to focus on are the industry economics, the tailwinds, competitive strength, competence of the management, and most importantly, the valuations. Right? If you're going to hold for 3+ years, valuations matter a lot. Right? Now, let's say you've done all of this analysis, right? You searched for the stock. Your time horizon is 3 to 5 years, even more maybe. Did in-depth fundamental analysis. You then need to start thinking of your entry criteria. And at this point, usually you would want to see, what are the long-term odds am I getting? Am I able to, is my downside at 3:1 odds? Again, a little bit of, uh, poker, betting kind of a terminology. But what you're saying is, for every 3 rupees you make, will you lose maximum of 1? And, you can do that through valuations, evaluating what is the max downside, those kind of things. You may be looking at earnings inflection as an entry criteria. The structure of the industry is changing. There is a momentum which is building in the industry. Let's say for the chemical industry, that was happening, or the financial services industry, or things of that sort, right? At that point of time, you're also looking at, are there any qualitative changes which are happening? There is improvement in the in the economics of the industry. The industry is consolidating, for example. The management's capital allocation is improving. So as you look at all these criteria, a lot of qualitative criteria, you will arrive at a composite picture, and you will maybe start a position. Again, to one of the questions which came up, right? At this point, you haven't connected all the dots, but you have enough confidence to say, let me start with a certain position size. And then you will keep adding to it as the thesis starts playing out. So you don't have to add this month or next month. You will learn, you will understand, and it takes a decent amount of time for you to get a really good understanding of the company. And as they say, oftentimes the understanding comes after you have bought it. Like, really, you really know a company after you have bought it. And then as the thesis plays out, you can keep sizing up the position. And at the same time, right, if the valuations go to extreme, you may even start cutting down the position. Or if the thesis just breaks completely, right? What you thought X will happen, and the management turns out to be, a completely different, right? The major ethical lapse happens, right? You may just want to exit completely. But your best case scenario is you find the HDFC in 2000 and you never have to sell it. Like that is the goal. Most of the times you will not achieve that goal, but that is your North Star, right? So your process over here, as I started off in the beginning, right? It matters what time horizon you're working, and then your criteria with valuation being a crucial point in that, and the management quality and the industry economics is crucial over here. So if you're this type of an investor, this is how you're approaching it. Now let's say, and I'm giving an example over here. Again, this used to be an old holding for us. We no longer hold it, but Venati Organics is one such company. You know, all these green star is when we actually bought it. And one of the things, you know, we've just called out, right? What exactly, you know, why did we buy it at that time? You know, the company was in the specialty chemical space for a long time, way before, you know, specialty chemical became a term and a fashionable term on top of that. And, you know, they were developing new products such as ATBS, good management, you know, really investing money way before, like everybody used to be in the commodity space, you know, during this era of 2011 and 12, but not everybody, a lot of them, but these guys they were always focused on niche and specialty chemicals. And then one of the elements of this kind of investing is that you will have these long periods where nothing happens. I think that recently a question came up, right? Earnings is doing well, but the stock is not doing anything. You have to ask yourself that question. If I'm a buy and hold, then I have to, you know, that comes with the territory. If I don't have patience, then, you know, reduce your time horizon, move into a different type of investing. You will not get a buy and hold position which will give you a 20% CAGR every month, every quarter, every year, right? It will happen in bursts. Pick up any company, pick up their charts, pick up their stock history. That's what you will see. The best of the companies will give you returns in burst. Then they have periods of time where nothing happens. So you have to get comfortable with that. You know, it goes with the territory. Now let's look at the next approach, and I will run through all these three, and then maybe we'll open for questions, because it's important for us to kind of see how your process varies and what factors you have to focus on. It depends on what is it that you're trying to do. It's very obvious in all other forms of activity, right? If you if you are an engineer, what you do is very different from what you do as a doctor, right? It's almost a facetious example to give. That's true even in investing, although we bucket everything into that. Like an eye doctor is different from a brain surgeon, right? Hold, and they are not arguing against each other, right? Saying, oh, brain surgery is better and eye surgery is stupid and vice versa. But somehow investors get into those arguments for absolutely no reason. So now let's look at deep value, right? You're, and again, these are not hard and fast, but these are instructive. You're looking at, you look like all-time low valuations. You know, it's a depressed stock. Everybody hates it. Like if you go to a meet with if you go to a party and you're talking to your friends and you talk about the stock, they will look at you as if, like, you know, you've lost your mind. Like, why would you be stupid to buy that stock? Like, why will you buy a travel stock in the month of May 2020, right? They say, like, what the hell? The world is not going to travel, or a hotel stock, right? So that is, you know, that is deep value. Like, you should feel that, you know, you should feel scared of telling about that company to anybody because they will ridicule you. That is deep value and requires a very different mindset to do that. Now, you can use a little bit of technical analysis. You can look at, you know, is this stock still dropping? Is it in stage 4? And I will not be able to spend too much time again explaining stage analysis. You can easily Google it up and find out, but it helps a little bit, right? In terms of knowing, you know, is the stock still dropping, or it has now gone into that neglect phase, which is stage 1, or it is early, it is starting to break out, which also you can corroborate from a fundamental standpoint. You can look at, you know, is the top line starting to move? Is it at least getting, is it stopped getting worse, right? Like, have the losses at least bottomed out, right? Is the industry at a bottom? You know, and again, no fine line. You can do a lot of deep research in the industry and find that out, which a lot of, you know, really good deep value investors do. But if you don't do that, at least then, you know, you have to give a little bit of upside, but you can wait for the turnaround, that early turnaround to start, right? Again, come to the same point. What will be your entry criteria? You start a pilot position, buy a little bit in an early stage, right? And then you start adding as the industry starts recovering. Now this stock, think of it, right? We'll give an example over here. Thomas Cook, again, old holding, not a recommendation, same point. You can see over here, right? March 21 and 22, right after COVID, the operating margin used to be like low single digits, went to -44. Like the company was kind of backstopped by the parent who put money into the company. Like they issued some preference shares to their parent company Fairfax, and to get over this crisis. So travel had collapsed, margins were at decadal lows, valuations were at low. Now imagine talking about this stock to somebody who is a swing trader or a position trader. Will it make any sense to them? Absolute zero, right? They'll say, why do I even want to waste my time if the stock is not going to do anything for the next 3 to 6 months? But if you're a deep value guy, you will think of it differently. You will think the stock is like all possible negative news is priced into it and more. The stock is priced for the end of the world. And if the world does not end, it will go up. And I have patience to hold it for the next 2 to 3 years as the stock goes up. And we see that time and again. This has never been a holding for us. Again, just for example, Bajaj Hindustan, right? Sugar stocks, steel stocks, these sectors, offer, these kind of opportunities more often. But you can see this over here, right? March 2021, operating margins was as 2%. Valuations at that point of time, and this is, I will try to magnify it. See this valuation? I did not pick up P and EBIT, anything else, right? Because the earnings had collapsed. If I had tried to pick up P ratio, it's like negative. If I tried to pick up operating profit, the valuations would show very high, like EV to EBITDA. So what I did was, to get a better sense, I put market cap to sales. So you can see this, right? Almost like in a 10-year or a 10-year period, the valuations were at the rock bottom, margins were at rock bottom, right? Didn't have to do a whole lot of analysis. You could see that the entire sector was in a downturn, and that was this was a good zone where you could buy it as a deep value investor. So now let's move to the next one. Now let's look at this one where again, I'm not an expert in this, but we'll just try to compare and contrast. Now, as a swing or a position trader, your search criteria is moving. You're now trying to look at the price volume action. You're trying to see, okay, where my base formation is happening. And some of these terms may make sense to some of you who kind of follow this, but if you don't, just Google them up. A base formation is basically where the stock is just kind of, not doing anything for long periods of time. Right? That's a simple explanation. Nothing is happening, right? It's kind of dead, right? Time periods vary, but that is what is happening, right? And then you start seeing, there is some activity which starts happening in the stock. The stock price starts rising. It's called a breakout. The volumes start increasing, right? So you have these various filters and search criteria. And usually, if you're doing this, your time horizon is weeks to months, right? Now, you can see search criteria in the circuit. I've not called out valuations. Why will valuations matter in this? If your window is 6 months or maybe 9 months, all that you're doing is you're playing a momentum kind of a swing or a momentum burst, if you may call it, for a 3-month period, or at best like a earnings momentum for 6 to 9 months. And if you do your research, you will realize even a 100 PE stock can be a good position over here. You can buy an EMS company, an electronic, a manufacturer like blanking on the names. But a Dixon or somebody, and do well in this time window. It can be a 120 P solar stock also. But do not make the a mistake of saying, I will now buy a 100 P stock and I will hold it for 4 years. Because eventually, no matter how well a company does, uh, valuation act as gravity. Now, obviously, some companies have defied that for a period of time. Like for every DMart, whenever this gets said, people will say, oh, DMart, or will say Asian Paints, or will sell some other company. In those cases, valuations did finally catch up. It just took longer than maybe 2 years. It took maybe 5 years, 7 years. But eventually, it always catches up. But that's not the game someone is playing when they're doing swing or position trading. Right? They're looking at a earnings or price momentum for a short period of time. And what you see on social media is maximum amount of people are talking about this, because this is where the action is. This is where all the excitement is. Now, if you're playing this game, dive into it. Then ignore valuation. If somebody writes, "Oh, people are buying this stock at 100 P valuation," what are they thinking about? Like what is going on through their head? Exactly, they're not thinking about valuations because it doesn't matter for their time horizon. So you have to know what exactly you're trying to do. And again, just called out, right? You will do some amount of technical analysis. Most of it is technical analysis. From a fundamental analysis, if a buy and hold investor is 95% fundamental and maybe 5% technical, even if that, this kind of flips that whole equation around. A swing trader maybe 90% or 100% price and chart investor. They would actually want to ignore fundamentals so that they don't cloud their judgment, right? If you are a position trader, maybe you will do 50-50, right? You want to see, is the earnings momentum going to be there? Is there a theme, right? So your entry criteria is, instead of a long-term uh, risk reward that is high RNR, here you're trying to look at a short-term risk reward, right? You will say, I will put a stop loss in place. So which is why when you see people saying, I always have a stop loss is a perfect idea for position and for swing trading. It is the stupidest idea for a value investor. It will be a dumb idea for a long-term buy and hold investor. Your stop loss is your position, or it's the depth of your research, right? So when somebody says stop loss, you have to step back and think, does it fit into my approach? Does it make sense? And what makes sense in one approach may not make sense in another approach, right? And then obviously, the steps are the same. You will do position management. You will maybe sell into a swing high, or if it is a position trade, you will hold till the earnings momentum is intact. And then maybe, at a certain point of time, as a stock runs up, right, it gets overstretched. Those are other terms which people use, right? It's way above the moving averages. You will want to start taking some profits off and start managing the position. Again, very different from what you're trying to do as a buy and hold, right? Because what happens in a momentum process is that there are these things called as momentum crashes. The stock will keep going up, 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 and then suddenly in a matter of a week, it will start crashing. So you have to have a process of taking your profits off on a regular basis. And again, I've just given a very quick example over here. And this is Mazgaon dock, right? You can see this is the long base period which happened, and then this breakout started, right? And then what was the reason? There was a triple digit earnings catalyst, right? If you can see the screen, it's a little, see this over here, 121%, right? So there was an earnings catalyst, and then on top of that, the whole defense theme started. And so a trader could have easily bought over here. A swing trader would play this zone. A position trader will say, you know what, 200-day moving average is my support. So I will hold it till the stock breaks through the 200-day moving average, and I will play a much longer, kind of a period. Whereas if I am a swing trader, I will allow this high to happen, and then as it breaks through the swing low, I will sell it off. So again, uh, a swing trader and a position trader also will play it differently. Versus, let's say if it's a growth at a reasonable price, that person will be out once the valuations start getting too extreme. But they would be buying somewhere over here, right? Like when this stock was really cheap. So if a value investor buys at around 100, they are thrilled to sell it at 300. They made their 3x. A swing trader will take it from 160 to 320, doubled in a matter of few months. They are also celebrating. A position trader, right, is making from 120 to, let's say, 600, 5x, right? So everybody is happy, right? They made their money. Nobody's smarter than the other. They just played different different windows in the same stock. So you can be doing, different people could be investing in the same stock with very different mindsets, with a very different methodology, right? So okay, so we are coming towards the end of the presentation. I think we already covered these points, right? About what is a mental model, and this is the point I was making, right? Basically, one man's garbage is other man's treasure. What makes sense for one type of investor will, and you can, as a summary, right, what you can do is you can look at these as different tools in your toolkit, and you can mix and match them. You can use it to inform your current style of investing. You can diversify across styles. If it works, you can be, if you can mix. Let's say you can be a deep value investor and a buy and hold. If it works for you, you can be a position investor or position trader and a growth at a reasonable price. Go deep into each specific style. Don't just jump around all of them. Don't be a swing trader one day and then a position trader other day and a buy and hold other day. you know get clarity on each, and then when you're getting into a stock, think of what you're trying to do in that specific case, right? Don't jump buckets. If you're going to do a position trade on a stock, have reasons very clearly laid out beforehand and then follow that. So I'll just stop here. I wanted to get through these three broad areas. We have run around 15 minutes over. I mean, if people have questions and want to stay around, we can continue for a little longer. But I've Prince and
Thanks.
Kedar, I think we have completed. So
Yeah.
I just wanted to ensure that we share everything before we get into questions.
Thanks, Rohit. A couple of questions in the comments, so I read it out. So Vasant Kumar has an interesting question. So he's asking, if you were not just managing money or running any advisory, which strategy you would follow yourself? Because the question is important, Rohit, because when it
Yeah.
comes to managing outside money or maybe the advisory thing, then altogether the risk factor, which is to be taken care of
Right.
great importance for individual, we can somehow can take a different practice. But again,
Correct.
yeah, over to you.
So I will break down that question into two parts, right? Or two sub questions. Do I want to be an active investor or do I don't want to be an active investor? If I am not an active investor, and this is what I have started recommending for my own family, I will never pick stocks. Right? I will either go with index funds or I will put it in a mutual fund in SIP, and that's about it. That is what I would do if I was not interested in investing. That's the key point, right? If I was not interested in active investing, because it's a lot of work, and I wanted to take advantage of the power of compounding and the country doing well. So that would be the first thing which I would do. Now, obviously, in my case, and a lot of people in my family have no interest in investing, right? Like, interest in the sense active investing. So this is what I recommend for them, and that's what they do. If I'm interested in active investing, but if I'm not managing money, I will be more, the bulk of my money would be in an area. For example, for us, it would still be in value / growth at a reasonable price, because that is where we have spent most of our time in. I have spent my time in. My partner has spent his time in. The other areas would be experimental. We would play around a lot, right? Because if you're not managing other people's money, you can do swing trading one day, position trading one day, and even now when we do that and when we try it out, it is always with our own money, because I don't want to learn or my clients to pay the tuition fee for our learning, right? So you tend to you experiment with a small amount of money, right? Like, take 0.5% of our portfolio and try it out. Try out position trade, try out swing trade. But being a value investor at heart, being a growth, the growth growth at a reasonable price, that's where the bulk is, because it allows me to go deeper. So that's where the preference is.
Right. Shri Nivas has a question. So how do we decide what price to pay for GARP stocks?
That's a seminar in itself, right? Yeah. It is very company and context specific. There is no simple answer for that. A steel company is different. It is all industry specific, time specific. What you will realize is that there is no, a 20 times P versus 30, 40, 50, there is no fixed number. So, I really cannot break it down into a quick 2-minute answer. All that I can tell you is that keep a range. If it's a cyclical commodity industry, you don't want to go above 15. If it is a decent, a double-digit growth, reasonable company 30 to 50. If it's in a high growth phase, has a theme behind it, right, competitive advantage, you can start going above 40 also. Roughly, again, very rough guidelines, right? You have to dig into the company. You have to do the work. No formulas,
Right.
unfortunately.
Right. So Biman Sharma, he's asking how much importance you give on tax considerations, especially for the short-term ideas where a stock is held for less than a year. Example, special situations, opportunistic bets.
Right.
Considering the short-term capital gain is raised from 15% to 20 odd percent recently.
Correct.
So
Right.
surely this have an adverse effect on returns. So is it beneficial to look more into long-term idea instead of short-term opportunities or special situations to say?
I'll let me answer it this way. One is, I never want to look at tax always pinches when you're paying, but I don't want to muddy decision making based on that, because because trying to save that extra 5% tax can lead you to a very wrong decision. Your profit, if you are into short term investing, your profits can turn to losses just because you were trying to, uh, again, not directed at this person, but I will say I have seen people get overly cute in trying to save taxes. Like, let me try to fine tune this to the last minute. Don't get into that. If you are up, if you are up 75% or 50%, take the money, move on. If your process is giving you a sell signal, it's all about the process, right? And in the process, I don't have tax, right? It's a good problem to have, right? I made 50%, now I'm paying a tax. So if your process says it's time to exit, right? Don't add an additional and an unnecessary variable of taxation. But from the broader standpoint, you're perfectly right. Over the long run, tax does matter. Again, it comes back to the point, what are you comfortable with? If you are proficient in position trading and you can do a very good job at it, then that's the area where you should operate and then pay the tax whatever you have to pay. Other versus if you are proficient in a growth at a reasonable price and that's where your comfort level is, then operate in that, right? And yes, you will pay lesser taxes, but if your temperament is positional trading and you cannot bear to see a stock go down 25%, then what's the point, right? Like, there's no point in trying to be a long-term buy and hold if you cannot stomach a 30-40% drop in a stock. You will never be able to get to that point. So tax should be the last. In my personal view, tax should not be your driving criteria. You first have to answer for yourself which bucket you fall in, which process you will follow, what is your process, and then let tax be just like okay, I have to sell it today versus if I hold it for another 5 days, I should be able to save 5% tax. That's all. Beyond that, I really don't look at taxes in that sense. It definitely pains when I'm filing the taxes, but not at the time of making the decision.
Fair point, Rohit. So two quick questions. So one is how much weight do you give to DCF? And secondly, the person is asking how you decide on sector rotation. Is it part of your process or I mean, you doesn't go that way?
Sorry, what was the first part? How much weightage I give to?
DCF, how much weight? Yeah,
Oh,
discounted cash flow. Yeah.
huh. So way back, right before we started the advisory, I used to sit down and do a very elaborate discounted cash flow exercise and all that. And then, once me and Kedar started getting into this and we started looking at we realized that, we were wasting our time, days trying to do it because you can pretty much work any numbers into that. So we no longer do DCF, right? Just do a rough cut valuation as a range. Like, this is the lower end, this is the higher end, this is roughly this thing, and just work with that. So not too much weightage, right? That's what I can say. So that's first part. And I think second, sector rotation, again, it's not a very conscious decision. Instead of sector rotation, what we try to do is we are more focused on diversification. We do not want to overweigh ourselves in any specific sector just because it is hot or something. There are some sectors which we may not be comfortable with, but we are more focused on sector diversification versus trying to move, very nimbly from one sector to the other. So So and then within our own advisories, we have set those guidelines to to avoid getting carried away by by some enthusiasm in a sector, and that's always the risk, right? Every 3 months, people will be jumping up and down about this sector and that sector. Again, same question. If you are a position trader, it makes more sense. If you are a more diversified growth at a reasonable price, that importance goes down. You can be diversified across sectors, and the good thing is something will always be doing fine, right? If you are if you are in hospitals and PSUs and financials and banks and healthcare and pharma and this and that, some part will do well, some part will not do well. That's the great thing about diversification.
Perfect. So Ajinkya is asking, we can take quantitative calls by interpreting data, but what about qualitative calls or a gut feel or decisions which you cannot explain with numbers?
That comes through reading. You have to just keep reading. You have to develop through experience. Um, Quantitative is a very good way to start off. It helps a lot in terms of having rules of what not to do, right? Quantitative rules you can always have, which can say, I will not buy a stock above 80p, or I will not buy a stock above 70p. Doesn't matter if people do well, because the odds are against me doing well. Again, let's come back to the same point. I am a growth at a reasonable price. The part being reasonable price is important, which means I will look at valuations, and hence I will have this rule. Versus I am a positional trader. I don't care about valuations, but I want my stock to be delivering at least 30% sales growth for the last 1 quarter. So put those rules down, those quantitative rules down. If you can backtest them also, right? That will form the baseline of your process, and then start adding a few additional qualitative factors in the way that, okay, 30% growth. Now there are 20 stocks which are 30% growth. How will I further filter it down? Then use the qualitative factors over there. Maybe you will say, I want to look at industries which seem to be doing well. So look at the competitors, how they are doing well, maybe pick that. So that allows you to filter. So use qualitative factors as your first cut, and then qualitative factors to finally zero down between two very similar positions. Again, no straight answers, but you will learn by
Right.
experience.
Right. So Maulin Patel has a question. So is the managed account style more of investing like your own portfolio, or is it still like a model portfolio in aggressive style? Question is from risk reward angle.
Yeah, that is going to be talking our book. I will only take 2 seconds on it, because both me and Kedar don't want to talk about our advisory on this call, but it is more like our own personal portfolios. That's all I will say. I don't want to, get into a sales discussion here now. It's more like our own personal portfolios. So it has a higher risk reward for sure.
One question is on special situations from Hitesh Jain is asking how to play with the special situations. 1 second. Holding a few companies from a long time, but things have not started.
There are two questions, right? One is around special situations and a long time where nothing has happened, right?
Yes, yes.
Okay. So I have stopped looking at special situations for some time in the traditional sense, right? Like a buyout offer, all that, because the amount of time and effort and the returns are not very commensurate. That said, on and off we do look at spin-offs. We do look at, in the sense, special situation where if a QIP comes, our antenna goes up. So there can be special situations where you can actually get cautious as to what is happening, but we don't spend too much time because the market has become very competitive. The second question, it's a tough one to answer. It is very context specific. What do you mean by not happening for a long time? The not happening has its own element, like the stock is not going up or the earnings are not going up. Long time varies from person to person. For me, a long time will be 2 to 3 years. After that, I will start getting uh, you know getting a little concerned as to why are the numbers not catching up. For somebody else it could be 1 year. But keep in mind, if a company continues to grow earnings at a 15% plus at a high return on capital, eventually the price will follow. In majority of the cases. Why majority? In those few small cases, there could be the chance of a fraud, which means the numbers are all made up, or it could be temporary. Like, the industry is just going through a 1 year or 2 year cycle, right? And the numbers will look good. But any company so you have to think in those terms. Like, are the numbers doing well because the industry is in a upswing, uh, or the market is just ignoring. But after a certain period of time, if it does not do well in spite of all, then you have to have your own cutoff criteria. After 2 years, no questions asked. That's like a time-based stop loss. Some people talk of, right? Like after 2 years, or 3 years, if nothing is changing, the stock continues to stagnate in spite of whatever numbers, let me cut and move on. I'll come back to it again.
Rohit, one
Any other
question
question?
which majority, yeah, one question which majority of the participant basically came across is like the number of stocks they have. Some do well, some do not do well. So
Mhm.
that balance outs, and most likely they do not make even index beating returns on the
Right,
portfolio level. In that
right.
case, how to come to a position, at least if we are doing active investing, there has to be some alpha to the indices, right?
Absolutely. So the first thing is, you have to again. I'll revert back to the original thing that our time horizons are a little longer, so you have to give it time, right? You have to look at it in at least in a 2 to 3 years rolling period, right? You should not be looking at beating the index every few months or every year or something like that. So that's one thing. Let's assume after 3 years also it is happening. Come back to the point as to why are you investing. It happens to a lot of people, and it happens to even people who have done well for a long time. You will get stretches. you know we have seen that in our advisory also. You will get stretches where you will not do as great, and then you will do in stretches, you will do well. So if you're not doing well for a certain period of time, the earlier slides which I spoke about, right? You have to start digging deeper and be honest with yourself. Don't blame others, right? Be honest with yourself and see, okay, why are you not doing well? What are you missing? And then look at the each of the steps. Are you missing out? Is your search criteria not? Why is your search criteria not able to catch those winners? Is your entry process properly defined? Are you chasing stocks which have already run up and you're feeling FOMO? Is your exit strategy bad, where once you hold a stock, you're not ready to exit because you don't have any exit rules? So define. As you do this, the first step you should do is, it plays exactly into what we have presented here. Write down your process, write down each step of what you are doing as of now in your process. And then every time when you buy a stock, step through the process, step through each point like a checklist. This. And when you sell, again, go through that checklist, right? And after every time you complete out a transaction, go back again, right? And that's the last point in this, right? You keep looking at your process, you keep deepening it, right? Eventually, if you keep at it, uh, you will do well. And which is where I came back to the original point somebody asked, right? It's a lot of work. Is it worth it? You'll have to ask yourself. Oftentimes it may not be, based on the time which you spend. So then you have to ask whether the alpha is worth the time you're spending. I know nobody says that, but that's the hard reality also.
And Rohit, an extension to the question follow basically. So in this also, like there are times when we are doing the right thing, but and the things are not materializing at that point in time, and that
Right.
creates the fatigue. And at that point in time, uh, be it the anxiety or behavior thing, we end up making the wrong decisions
Right.
at the wrong time, in the sense like the picks which you already have picked were about to pick
take
or
off.
maybe materialize. So at that point in time, we
Correct, correct,
totally take the opposite decision of selling those and entering
correct.
into something new. So how to
Because
curtail that?
because one of the things is on social media there is always somebody beating their drum, right? I am doing this great thing. I am doing that great thing, right? So the first thing I'll tell you, just some pointers. We'll not get into specific names or anything. Whoever is doing well, right, at a certain point of time, track their performance over the long run. Not about this 6 months, not about 9 months. Look at it over a long run. And you will realize that everybody has their ups and their downs. No strategy works all the time. 2020 mid to 2021 mid, or maybe 2022 early 2022, or it was all momentum. I will, do this quantitative investing and that and this, and it worked. And then they have had a lull, and then they will do well again. Over the long cycle, they will also do well. Then there was a time when all the deep value guys did well, right after 2020. Then there was a time when so FOMO and avoiding, I will tell you, among all the aspects of investing, it is the toughest part. And you will be fighting this battle with yourself even after 15, 20 years. It never gets easy. So the only way you can do is to put a structure around your process and stick to it. I am this type of investor. Follow that and then be honest with yourself. Are you comfortable with it? If you say I am a growth at a reasonable price and you get all anxious or irritated if your stock is not doing well after 6 to 7 months, then you have to ask yourself, why are you calling yourself as a growth at a reasonable price? No problem with the strategy. A problem is with, view, as in, like I'm saying, with all of us, right? Then maybe your temperament is more around the positional trading side. Forget about growth at reasonable price. Forget about long-term buy and hold. Or maybe you're a deep value guy who likes to buy stuff which is like complete rock bottom, and you would literally just feel nauseated if you see a stock sell at 50 times earnings. Then become that, and then just stick to it. Doesn't matter what everybody says, right? It's not easy. It's a very tough way to do it. But you can't be everything at all the times. You'll have to decide, and then you will have these long periods where your strategy will not do well, and you know what, you'll have to make peace with it. Or maybe you can pick more than one strategy wherever your temperament kind of fits, and then you can balance it out a little bit. So maybe that's the approach.
Perfect. So, Rohit, we have already taken much of your
Yeah.
time, but one last question, which I think is pertinent. You please take 5 minutes out and share your view on the Q4 earnings, although we are very near to the Q1 earnings starting. But again, how had been the earnings last quarter basis your expectations, and how materially it impacts your process to say, like, I mean, you monitor quarter on quarter, or you give some extra time, in the sense 3 4 quarters at least, before taking any decisions on your holdings or recommendation?
Yeah, we generally take more than that. I mean, we'll allow a few quarters to pass. It's never a quarter on quarter, unless if it's a positional trade. If it's a positional trade, obviously, it's more a 2 or a 3 quarter kind of a thing. So a quarter matters. If there's a surprise quarter where suddenly the numbers have suddenly shot up, so it comes to the styles, right? If it's a growth at a reasonable price, usually, the quarter is just one of the bullet points or a dot along the way, and you're just trying to see if the trend line is correct, right? The company is continuing to grow, right? Did it come within that range, or was there a major surprise? And how did the management respond around that, right? So for example, right, you are looking at, let's say, the banking industry, right? And most of the banks have come in a certain range. They were facing a pressure on names, so you know roughly in what range they will fall. And if it comes around that, then you're okay. And then some sectors will give you a surprise, so you want to look at that. And that's where you can start researching. Okay, these sectors have given a high growth rate, but have they been doing it for the last few quarters, or this was a first surprise quarter? And maybe you can look at it from a positional trade standpoint. So it depends on the type of in a positional trade, the quarter will matter more. But anyway, those are much smaller part of our portfolios. Most of them are growth at a reasonable price, and we will give a couple of quarters and see, how it plays out. On a broad basis, I think, the at least wherever I looked at, surprisingly this quarter the numbers were fairly okay, right? Most of the industries seem to be performing. The financials, the financials were, financials were doing well. They are kind of coming out of a trough. Uh, Infrastructure started, picking up. Some of the EPC companies started doing well. Uh, Again, I'm going top of my head. Pharma, hospitals, CDMO space, that is doing fairly okay. Uh, Electrical and power transmission, that was pretty good. Defense, the excitement is there, the numbers have yet to appear, but again it's a very lumpy kind of an industry, right? So the HALs and the GRSCs of the world, the numbers may suddenly come at 300% because that's how contract and project work happens, right? You deliver a couple of ships or whatever, big projects in a particular quarter, and usually it is Q4. Now numbers will suddenly spike, and then you will get, we see, right, a lot of the market is quarter to quarter, right? So everybody, a lot of people say I'm an investor, I will hold for 2-3 years, but the average, if you really look at how the markets have started trending, it's mostly swing trading and a few positional trading, right? That seems to be the weight of the market, and that's where the maximum amount of kind of chatter comes on social media also. But if for majority of our cases, right, we would end up taking like a 2 to 3 years kind of a viewpoint. So every quarter is not that important. It's always like a dot, on the trend in terms of, where that trend is moving. So hotels are doing well again, travel is doing well. FMCG, again, I really doubt, in the scheme of things at their valuation, right? What is the, what is the real upside on FMCG companies, right? With all the competition which is coming in and all that. So that used to be our go-to area, half a decade back, no longer so. Commodities, we usually really don't track as closely, right? Only if something really interesting comes up through a screen, right? So we have screens where we will look at companies which are selling at their 10-year valuation lows, right? So again, not a recommendation. For example, right? Sometime back, Kotak Mahindra and some of the banks were coming up over there, right? By the way, we don't hold it, but I'm just giving that as an example. So that's an area where you can look at, right? You just run some screens on the valuation bit on that search criteria, and so quarter may be bad, but the valuations are at such rock bottom that it's a good idea for you if the quarter was bad, right? Just completely flip the point around. Worst quarter, everybody hates it, but as a deep value guy, you are all excited now because it's come at a point where it will not get any worse. It's so a very high level,
Perfect.
Prince.
No, that totally makes sense and really helpful, Rohit. So, Rohit, I think more or less all the questions in the comments are well taken either during the presentation or after the
Right.
presentation, and it was a really helpful session in the sense that you provided the perspective, which I think our audience who joined today and maybe subsequently people who will be listening this on a YouTube channel of ours. So definitely a great value addition, and certainly the attendees can have their questions if there are any left questions. So they can certainly tag you over social media or maybe write an email. And
Yep.
if somebody is interested in the services, definitely they can reach out over an email.
Yeah.
So thank you so much, Rohit, for your
Thanks,
time.
Prince.
We'll surely connect again, and always a pleasure hosting you.
Okay, thank you everyone, and please feel free
Thanks,
to
everybody.
put questions on Twitter or social media, or you can send a question to me or to Kedar also, right? And Prince, and we can answer for all of you. So thanks for everybody's time. I will stop the recording, and thank you everyone for joining.
Thanks,
Thanks,
everyone.
Rohit.
Thanks.
Thank you.